Trading platform Public.com now offering options trading. Retail investors use the platform to trade ETFs, bonds, stocks, crypto, and other assets. But it hasn't used payment for order flow in its revenue model since 2021 until today. And we're going to talk about it right now. Joining us right now with more on the state of the retail traders in the new year, Jannick Malling. He's the CEO of Public.com. Good morning to you.
Good morning.
So for those uninitiated who may not remember the debate that really took over the public discourse for a while about this flow situation, why don't you explain what you decided to do then and what you're deciding to do now?
Right. So in our equities business, where you're just trading single stocks, back after the events of GameStop, we decided to abandon the payment for order flow concept. Yes. The market structure, and today we're launching options trading.
And payment for order flow, for those who don't know, meant that the Citadels of the world and other folks who were effectively paying you or paying Robinhood for every transaction.
Correct.
And so there was always a question of who was the real customer. Was the customer the one that actually made the trade, or was the customer the market maker who was paying you a fee for you to trade on their platform?
That's been the discourse. And I think at the real heart of that discourse is, what are your incentives as a broker-dealer, and are they aligned with those of your customers?
Right. So you stopped doing it.
Yes.
Did that work for you, first of all?
I think it worked incredibly well. We proved on many occasions that we saw, at many times, more often than not, at least, better execution, because we passed a lot of those savings back into the hands of our customers because they got better execution by us going directly to lit exchanges. There continues to be a lot of discourse. The SEC came out with a proposal, as you probably know, also denoting that there's some conflict of interest here with regards to this model. Now,
it's not allowed in Europe, for example.
It's not allowed in Europe.
But it's
not allowed in Australia either, and maybe Canada as well, I think. Now,
but we should also say that Ken Griffin, who's been on our broadcast before, has also said that he believes that he's actually offering better pricing, and that customers that are trading through them, where they're paying the payment for order flow, actually get a better deal.
Correct.
Then why is he paying for it?
Well, so there's a couple of different nuances here also, by the way, to be mindful of. Number one, the market structure on the equity side is actually quite different from the market structure on the option side. So let me explain. So if you buy an Apple single stock, some market maker pays for almost like the exclusivity to that flow, meaning that they will fill that order. No other market maker will see it. And so we'll never really know whether another market maker could have given you a better price. Now, the options trading market is quite different in that everything gets executed on exchange. So the market maker in the options trading world is really paying for a right of first refusal, or sort of like a first pass on that order, but it still goes to the exchange. And if another market maker comes in and offers a better fill, the customer will see the benefit of that. And so what's interesting is the SEC proposal sort of had some more lingo around this open auction model.
Yeah, that you can't
for the equities as well.
So, but now let's pivot to what you're doing today.
Yes.
Because that is a new announcement that actually relates to taking money for payment for order flow.
Absolutely. So options trading has been one of our most requested features in a long time, but due to all the skepticism of what the incentives are, how it all works, we thought long and hard about how do we bring this to market in a way where it's transparent. And there is no doubt that our incentives are aligned with those of our customers. And at the end of the day, what we decided is to pass half of our options trading order flow revenue directly back to our customers. This means that...
So you are taking payment for order flow.
So we will take payment for order flow on the options model, but pass half of it back directly to the customers. So it's not just a mechanism that benefits broker-dealers and market makers anymore, but end-user customers get to see the benefit of it as well.
This is a stupid question maybe, but that sounds like, okay, we're going to sell the order flow exclusively to one broker. We're going to get paid for that, but we'll give you some of the savings.
Well, we won't go exclusive. So in the options market, we will not go exclusive. Everybody will work with various market makers. It'll go to various exchanges. So it's a lot more of an open model. It's not this like restricted competition model.
But,
there
Jannick,
is actually competition for each order.
Why these guys will pay for this? What's to suggest they're not front running? I mean, why would they pay for the order flow?
That's been a big kind of question for a long time. At the end of the day, we're not a market maker, so we can't even go directly to the exchange as a broker-dealer with this flow. So there's no real getting around these market makers in the options trading world, like the model that we have for equities. We just can't do.
Let me ask you this, though. So this is just a sort of philosophical question. Those who actually are advocates of payment for order flow in the equities business would say that, in a way, some part of the payment for order flow is being shared, similarly in this case, like that you're doing, with the customer. Maybe not 50%. Maybe it's not very specific about how it's working. But the argument would be instead of a Robinhood paying up front, or forcing you rather to pay up front, that there's some shared cost, and that the benefit of payment for order flow is allowing people to make trades at effectively a cheaper price.
Right.
You buy it? You don't.
Some people position it as a trade-off. We don't necessarily see it that way. We think that there's a best of both world scenarios here, and that's what we're trying to do with our options model, where there's no commission, no per contract fees, and you actually earn an order flow rebate for every trade you make.
Question for you. Some people are now trading with you, I think, because they like the brand. They like what you're trying to establish and what you mean. The other question is, how many people you think trade with you or trade with whomever because of the feature set, because they like the app better, because they, I mean, how does this all work?
That's an excellent question. I think really this entire space breaks down to two things: technology and trust. And trust is something that in financial services has been a key term for a long time, but I would argue after FTX, after Silicon Valley Bank, even after 08, like, it's more important than ever. And then there's the technology set, which has much more to do with which products do you offer, how do you research those products. And so we've focused a lot on building a multi-asset kind of platform where you can buy bonds and options, crypto equities all in one place, and then get sort of real-time context around that.
30 seconds. Do you have a take on Bitcoin?
You know, we've seen crypto trading surge, obviously, in Q4 with all these ETF news. We're still seeing in the retail community after those ETFs came online that there's a lot more trading happening in the sort of traditional crypto, if you could call it that. That's kind of weird to call crypto like that, traditional, I suppose. The ETFs are among the more bought ETFs, but there's still multiples higher actual crypto volume happening on our platform.